We believe the metaverse will be the successor to the mobile internet. We'll be able to feel present, like we're right there with people, no matter how far apart we actually are. We'll be able to express ourselves in new, joyful, completely immersive ways, and that's going to unlock a lot of amazing new experiences.
Coming up in today's show, stocks finish higher led by tech, with Meta and Amazon adding over $250 billion in market cap. Jobs growth smashes expectations, sending bond yields higher. An unusual move from Apple. Bezos selling billions in stock. Q4 earnings update, and how to invest in the biggest revolution of our lifetimes. Welcome back to the Click Capital Daily Market Show, everybody. Hope you're all doing really well out there to start the weekend. I'm your host, Jared, and stick with me today because I'm going to run you through all the most important news, data, and charts across markets, get you up to speed, give you the 10,000-foot bird's eye view so you understand everything that's happening and all the most important trends and themes out there that affect all of our portfolios. And what an interesting week on Wall Street it has been. S&P 500 now within a stone's throw of 5,000 for the first time ever, finishing the week higher, and that was thanks to the Magnificent Six, which as a group were up a huge 6+% today, thanks to the absolute smoke show that is Meta Platforms, finishing the day 20% higher. Gapped up, held, rallied. There's a look at the 5-minute chart of Meta there. Opening up at 455, we're up 15% after hours yesterday as I was making the show. It's like a bull right out of the gate, ripped up. It peaked out for the day at 485 before rolling over a little bit in the afternoon. Same deal with Amazon, finishing the day almost 8% up and now climbing back to those all-time highs it made back in July 21 at 188, finishing the day here just below 172. Not wanting to be left out of the party was Nvidia, which also climbed almost 5% today to 661. And what a run it's been on ever since Nancy Pelosi and her husband loaded up on calls. Back in mid-December, we've seen numerous positive developments come out of the US government, like a new AI chip research program, partnering with Nvidia, US military and other agencies saying they're going to use these AI chips, and the US government also approving new types of AI chips for sale to China. All of which Nancy knew. That's why she told her husband to load up on calls, and how him, just a garden variety fund manager, and Nancy, a lifelong politician, have been able to build their wealth to over $200 million after a multi-decade career of insider trading. And this thing's just showing no signs of slowing down. Looks like we could be at $700 a share next week, and then who knows, maybe $1,000 a share this year is possible. Just looking at Microsoft, it's hovering near all-time highs as well, but not joining in on the party this week is Alphabet, actually finishing the week lower. Same deal with Apple after their earnings yesterday. Not to mention Tesla, which is not even part of the Magnificent Group anymore. It's lost that title now that it's the only one with less than $1 trillion market cap, currently just under $600 billion. There's a look at the daily heat map today, and quite check it out there. Obviously led by the huge rip in Meta, Amazon and Nvidia. Looking across the rest of the market, did get a little bit of a bounce in the financials. However, with those rip in the yields, the yield-sensitive sectors like REITs and utilities came off quite hard today. And just switching over to a one-week heat map, there's all the performances for this week. As we can see, a bit of a bifurcation going on within mega-cap tech with Apple and Alphabet. And the rest of the market, quite checkered out there. Even within the sectors, we've got spots of green and red going on. So no real clear theme developing in the market this week, even though we've got the main indices higher thanks to the big guys just doing all the heavy lifting like they have been for a while now. And just digging under the surface even further, looking at the best performing industries this week is one of my favorites, uranium, coming out in front, up 6.8%. Other industries like electrical equipment, food distribution, trucking, building materials, and a few other like traditional industries like railroads, farm products, and so on had a good week. The losing industries this week, freight and logistics, oil, gas equipment, REITs, oil and gas drilling, and department stores. So obviously the big news this week is the absolute blowout quarter by Meta. He absolutely hit the nail on the head and just gave the stock market algos a lot to dance to. Smashing beat, good guidance, first ever dividend payment, plus a huge $40 billion increase in their share buyback program. And you've got to love capitalism. It was only just over a year ago Mark Zuckerberg came online with a sad face, saying he has to lay off 13% of their staff, more than 11,000 employees. Got their walk-in orders, and that was so they could save $1.4 billion a year in costs. But that $1.4 billion in cost saving from firing thousands of staff pales in comparison to the $50 billion share buyback program. Not to mention their new quarterly cash dividend, and that's why we've got this stock up more than 20% today. And this is a theme we're going to see more and more of, especially in the tech sector, as they look to replace people with machines, further increase earnings per share and the stock price, unfortunately at the expense of a lot of skilled labor. And so not only is their ad business on fire, their year of cost efficiency of 2023 really paid off in spades. Got a very healthy business, stock price, balance sheet. They've also got the possibility of being the global leader of the metaverse. If they are able to pull it off, this could be a whole new source of revenue in them that takes them well into the future, 10, 20 years ahead. And Zuck seems to be really betting heavy on it. Thinks it's going to be the new, 3.0 of the internet and mobile, and wants us to go deeper and deeper in the digital world, away from meeting people in person, and they're just kind of spending most of our time in the matrix. We've already seen the mental health issues just from young teenagers being on Instagram all day. You can just imagine the mental health issues that are going to come from people spending more time in the metaverse than physical reality. Kind of begs the question, what is your reality if you're spending more time in the matrix as an avatar? However, that's just one side of it. The other side is going to be the huge business opportunity for gaming, things be able to see like your favorite musicians in the metaverse and all the apps and development that could go on within that. It's possible that the metaverse does become huge, massive, and takes Meta to greater and greater heights. And like I said, he's got the profitable Facebook, Instagram, and WhatsApp businesses to help finance that push into it. And so maybe the market is coming around to this and not too worried now like they were in 2022 of how much money they're pouring into the metaverse, because it could actually pay off huge dividends well into the future. So stick with Click Capital and I'll keep you updated on this theme going forward and how it plays out. It's very interesting, just to say the least. Moving on to the most important piece of economic data we got this week, and probably the second most important piece we'll get this month. And like we get on the first Friday of every month, that's non-farm payrolls. A look at the US jobs market and how many new jobs have been created in the prior month. And that absolutely blew past expectations, almost doubling what economists were expecting. Coming in at 353,000 new jobs created last month. And like I said on Wednesday's show, after we heard from Jay Powell, and he was kind of like, oh, hang on, no, we're not cutting rates in March. Not so sure when we got to cut. Like I said then, he probably had a heads up on the jobs report, seen it's coming in really hot, and that's the fuel for more inflation. A lot of jobs, a lot of discretionary spend, government still spending like crazy. We've got tensions in the Middle East that could affect oil. We've got shipping rates going up. Risk assets ripping to new highs. Doesn't really sound like the environment when they should start cutting rates. And so just looking at the monthly job gains over the last year, we were in a bit of a softening downtrend last year. However, the last couple of months have just popped up here. And once again, the economy just continues to surprise on the upside. And that could be putting Jay Powell in a tough spot this year. Got the 2024 election. Doesn't really want to increase rates going into that. Wants to stay in office just like Biden does. They don't want oil going up. They don't want inflation going up. They only want the stock market going up and gas going down. They want everyone feeling good going into November. However, can you just imagine if he was forced to jack rates? What a 180 that would be in markets, probably send stocks pulling back as well. And so there's still a lot up in the air before we get to this important date this year. And after that blowout jobs report, it's no surprise we got yields screaming back higher today after having been sold off this week and of late. Bond market's still not really sure when the Fed's going to cut rates. And we can see that once again at Fed Fund futures. Given 80% chance they're going to stay and hold in March, now growing to above 1 in 4 chance they're going to continue to stay and hold in May. So the market's just been continuing to dial back and back when they think they're going to start cutting rates. If we keep seeing these hot economic data prints, still got a couple of CPIs and PPIs to come in before they do meet on the 20th of March, then we may not just be getting those cuts soon after all. There's a look at the government bond 2-year yield today, ripping up 16 basis points, getting above 440 briefly. Same deal with the 10-year, up over 14 bips, reclaiming back above 4%. And the economy is holding up pretty good. We also saw retail sales coming above expectations. We keep getting these hot prints, then there's no reason yields can't keep climbing back up here. You can see that in the dollar index today as well. Having a really strong day, breaking out multi-week high on more than double average volume. However, the prospect of rates staying higher for longer isn't scaring the stock market bulls at all. We've got research out of Ned Davis saying this bull market really has legs and that we might only be still halfway through 25-year secular bull market, of which we've seen a couple over the last 100 years. We've seen other research as well. Some saying the secular bull started in 2009, some saying 2013, with projections that it could go right through to 2029, some even showing it could go through to 2035. We've even got some research out of Bank of America saying Nvidia could spike another 23% and that AI demand is still in its infancy, saying the stock still represents compelling valuation and actually increased their price target from $700 to $800 a share. Same results from top US cloud customers, suggests solid motivation for spending in generative AI. And who knows, they may be right. We did see Mark Zuckerberg talk about buying 350,000 H100 GPUs from Nvidia. Other big companies as well, Tesla, some of the biggest companies in the world, just can't get enough of these AI chips from Nvidia. And Jensen Huang has even said they don't have a demand problem, they have a supply problem, which could actually become a lot more acute if China wanted to throw a spanner in the works and go into Taiwan the next year or two, where a lot of big US tech companies still rely on for chips. And Apple's been falling by the wayside, overtaken by Microsoft as the largest stock in the world. And like I've been saying, they don't really have a blockbuster AI product to kind of get everyone buzzing about like their peers do. And so no doubt this guy here wants to jump on board the AI train. And they don't usually tease upcoming product events, but Cook's been hinting that they've got some things going on with generative AI that they're incredibly excited about and they'll be talking about later this year. Didn't provide any detail, which again is an unusual move for this company. And so far they've been pretty quiet about AI and how they're going to take advantage of this big movement in markets towards it. And just looking at a weekly chart of Apple, that's why it's been going sideways for the last 6 months, unlike some of its peers which are screaming to new all-time highs. And there's a look at a weekly spread chart of Apple versus the Nasdaq. Since peaking out in October 2022, it's underperformed by 22% just versus the Nasdaq. We've got others saying the AI hype around the Magnificent Seven stocks is just the latest example of big market delusions. That's Rob Arnott, who says today's AI leaders are unlikely to stay on top spot because disruptors get disrupted, which is true to an extent, I guess. Some of them are bound to be disrupted. However, Microsoft's been a top stock for 25 years now. One could argue the most important stock to America, closely partnered with the government for issues of national importance, and with their current infrastructure and budgets, it's hard to see some of these big guys really being disrupted. It's just valuations is the other thing that's probably more likely to affect them, as opposed to some small startup out of someone's garage coming out and taking them over anytime soon. I don't think that's going to happen. And Jeff Bezos' lavish lifestyle doesn't come cheap, planning to offload $8.6 billion in stock, selling shares for the first time in more than 2 years, and into the recent strength the stock price has had. No real news on what he's planning to do with all that cash. Maybe buy another big boat for his new wife. And just an update on Q4 earnings season so far. Just looking at the 494 companies outside the Magnificent Six, things aren't going so great. Overall performance of S&P 500 relative to earnings estimates continues to be below average. Looking at the S&P, 72% of companies have reported EPS above estimates, which is below the 5-year average of 77%. And in aggregate, companies are reporting earnings that are 2.6% above estimates, which again is well below the 5-year average of 8.5%. However, overall for a group, earnings are coming in positive, and that's now the second consecutive quarter of positive earnings growth after the market went through an earnings recession, 3 consecutive quarters of earnings decline. And surprisingly, not many people would realize this. It's actually energy leading in beats with 90% beating. Then we've got healthcare at 85 and then technology at 84. Moving on to commodities, we've got oil pulling back pretty good here this week, falling 7%. On the back of news, we may be getting a ceasefire deal between Israel and Hamas, something the US is pushing for. Everybody wants things to come down over there so we don't see any spikes in oil, which is a very important thing for the Biden administration this year. And that's why they purposely just waited for the oil market and stock markets to close before launching over 85 strikes on targets in Iraq and Syria, just hitting the wires now as I speak. Obviously not wanting to spook markets, they're waiting for the weekend to get this done so they can let the world and markets digest it. Biden will probably come out on Sunday night, may address it, try and cool things down so we don't get a huge spike up in oil come Sunday night when futures open. Although this has been well telegraphed to the world, the US was going to strike back after the incident we saw earlier this week when Iran-backed militants attacked a US base in Jordan, killing 3 soldiers, injuring dozens more, and it looks like they've just struck back at Iran-backed sites in Iraq and Syria, stopping short of directly targeting Iran or senior leaders, who I can imagine had been staying inside this week, especially after last time the US struck back was Trump killing Iran's number 2 man with a precision drone strike from the sky. So it looks like it was quite the efficient operation, all said and done in 30 minutes, targeting more than 85 Iran-linked targets. And so Iran vowed a strong response if the US was to go ahead with this, so it'll be interesting to see what comes out of them next week and whether they continue instructing their militant subsidiaries to continue attacking US bases in the Middle East, not to mention our cargo and shipping vessels as well. Not to mention we've got OPEC led by the Saudis still wanting to see a higher oil price and slashing oil production last month. However, because the US and other non-OPEC countries are pumping it out at records, we've still got global oil supply set to surge by 1.5 million barrels a day this year, and that's really what's keeping a lid on the price of oil. If we didn't have all that supply coming out of the States, the largest producer of oil in the world, oil would be a lot higher than it is now. Okay, just moving on to a bit of a special piece I wanted to do for you guys today on clean energy and some of the options we have to invest into it. But first, let's just dial it back a bit and just start with the basics. And I know this is a controversial issue. Not everyone believes in climate change. That's okay. We're all entitled to our opinions. However, I'm just going to present to you some research today, and I'll let you all draw your own conclusions from it. So it's true. The biggest counter-argument to climate change is that carbon dioxide levels, CO2, have been oscillating up and down for as long as the Earth has been alive. However, there's plenty of data out there that confirms that the levels of carbon dioxide in our atmosphere are at levels that have never been seen before, that we can trace back in things like ice. And they really started spiking at the turn of the 20th century, which just so happened to coincide with the Industrial Revolution. New energy sources like coal, closely followed by oil, really started to take off. Because prior to that, for thousands and thousands of years, humans pretty much just burned wood and other traditional biomass for energy sources. And to give you a bit of a graphical analogy, if you imagine the Earth as this fish tank here, full of plants and life, and the tank that it lives in is the atmosphere. And can you imagine what would happen if you plugged a car exhaust into this fish tank? What do you think would happen over time? Well, there'd be a lot of toxins trapped inside here. It would start to affect the plants, the lungs and breathing of the animals living in there, like we see with humans around major cities. It would start to warm up, and its climate and environment would eventually change. Now, I know I'm bound to trigger a few people by saying all this, and I welcome your criticisms and your comments. All I ask is, if you are going to criticize it, please back it up with some data or facts, instead of just saying the politicians are out to get us or anything like that. And so we're already seeing the effects of human-caused climate change. I'm sure a lot of you have seen it in your own lifetimes. I've seen it increase in extreme weather events, becoming more and more frequent and dramatic each and every year just about. So regardless of whether you believe in human-caused climate change or not, there are some other advantages towards moving towards clean energy, with one of the biggest ones being energy independence and security. And this is very important for all of us here in the West, of which over 90% of you watching this video are from. And so for almost 100 years now, we've been largely relying and sending billions of dollars to places like the Middle East to get the dirty black stuff and all the cause and havoc and wars that has caused, not to mention the corruption and misallocation of wealth over there. We can become a lot more stronger, independent, and secure by being self-reliant in our energy, and clean energy is the way we can do that. And don't get me wrong, fossil fuels will still be around for a long time. I'm not saying they're going away anytime soon. I'm just saying the future's pretty clear in my eyes, and that it's inevitable that within a lot of our lifetimes, the vast majority of our energy will be from renewable, clean sources, new technologies, not to mention the environmental benefits. And again, I know there's a lot of counter arguments out there for why it's not true. I've heard them all. However, wouldn't it just be best to hedge our bets just in case we are causing climate change and just go clean and green anyway and get off Middle Eastern oil? To me, it makes a lot of sense. And just looking at some comparisons of fossil fuels versus renewable energy, there are some advantages, with the main one being there's only so much fossilized plants and animal matter that we can dig out of the ground. Limited supply, it's going to run out one day anyway. Whereas renewable energy is abundant and doesn't emit carbon dioxide into our atmosphere. And I know this is a long-term theme. There's still a lot of hurdles to get over. It's not going to be linear growth. And apart from nuclear, uranium and hydrogen, which I covered in the previous 2 day shows, you're looking at the future of energy right here on the screen. Two big ones dominating, with the three biggest dominant ones so far: energy from the sun, hydro energy using the gravity of water and wind, and smaller ones being tidal from waves, geothermal using the steam from the Earth's crust to spin a turbine, and to a lesser degree, biomass, organic material. So just looking at the types of renewable energy, today the world already gets a bit over a quarter of our electricity from renewable sources. Like I said, the biggest being hydro, wind, and sun. And some countries are already getting more than half of their electricity requirements from renewable energy sources. Countries like Norway, Brazil, Austria, Canada, Sweden, Switzerland, even China, which is making big pushes into clean energy. They want to be the world's leader. It's 31% from clean energy sources, and the States coming in at 23%, with some of the countries using it the least: Saudi Arabia, Bangladesh, Iran, South Africa, Egypt, Kazakhstan, Thailand, Russia, and so on. And already, over the last 5 years, we've seen clean energy investment exceed that of investment into fossil fuels. And this is a trend that's only accelerating, with the world expected to invest on average $700 billion per year in clean energies, with solar and wind taking the bulk of that investment, with the entire renewable energy market expected to exceed $2 trillion by the end of the decade. And that's why I'm calling it the biggest revolution of our lifetimes, Probably the biggest change in our societies, secular trend from fossil fuels to renewable energy sources, and just what a huge opportunity it is, with 5.6 trillion expected to be invested over the rest of this decade into this sector. With, like I said, wind and solar taking the bulk of the pie, with even small-scale solar systems installed at the point of consumption expected to exceed the large-scale farms that feed directly into the grid. Not to mention all the satellite industries off it, like storage, technology, electric vehicles, so on and so forth. So if you're like me and you believe clean energy is inevitable and you want to be a part of the future, help finance it, and economically benefit from it, well, what are some investment options? And as usual, I have to start off by saying this is not financial advice. Please do your own research. I'm just sharing my research with you of some options out there anybody has to get exposure to this sector. So I'm just going to flick through a few stocks and ETFs, some of the biggest, most liquid ones out there. First, we'll start off with NextEra Energy, which could be the biggest pure play stock in the sector, coming in 119 billion market cap, still offering a healthy dividend yield over 3%, steadily growing yearly revenue. They're coming out of Florida, and a huge part of their business is producing and selling electricity from clean sources like wind and solar. And so they're very big in the Florida market, but they do have plans to lead the decarbonization of America, and they too are looking to reduce dependency on foreign oil with a number of different solutions. And just zooming out to a monthly chart, stock's already been a great secular winner, having increased from $12 a share back in 2010 to here we are now at $58. Another interesting play on clean energy is that of Brookfield Renewable Corporation, coming out of New York and with the market cap just under $5 billion, healthy dividend yield of 4.8%, growing revenues. They own and operate a diversified portfolio of renewable energy assets, wind, solar, storage, with geographical diversification as well across the Americas, Europe, and Asia. Coming out of New Jersey is Clearway Energy, also just under $5 billion market cap, 6.1% dividend yield, growing revenue. They're another solid operation with lots of wind and solar assets across the states. Eurozone has some big companies, which I won't go into as much, as most of you guys, like me, are interested in US securities, but just quickly flicking through them. There's Enel, Iberdrola, and Ørsted. Like I said, some of them are pretty big, 165 billion market cap, coming out of Denmark, and they are big into wind, onshore and offshore. Looking at some wind companies, SunPower, coming out of California, and again, a few other ones, big too, from Europe, like Vestas. More popular and liquid and well traded is that of solar, especially in the States, compared to wind in Europe, with stocks like First Solar, 15 billion market cap. They're out of Arizona. Enphase Energy, out of California. Revenue's absolutely steaming ahead. Canadian Solar, Jinko Solar, and Sunrun. Then, of course, you got the EV segment that we all know about, Tesla. The big one now in China, overtaking Tesla sales, BYD, which actually trades over the counter in the States. Rivian coming out of California, and Xpeng out of China. Now, to me, the safest way to play clean energy, like any theme, is through ETFs. Don't have to worry about quarterly earnings, problems with the CEO, tail risk, waking up one day, the stock's down 20%, etc. And don't get me wrong, ETFs are still risky. Industries can still have 50, 70% drawdowns. However, the good thing, that's what's already happened in clean energy. Looking at one of the biggest ETFs, the Invesco Clean Energy ETF, PBW, it's down by over 80% since the speculative peak in 2020. The market can really get easily excited by this sector like it did back in 2020. Everyone piles on. However, no matter how good the market, future growth or that, speculative bubbles always get corrected. And so traditional portfolio management will say this is more risky because it's more volatile. However, I agree with Buffett that the real risk is the chance of total permanent loss. And if something's likely to be around in 10, 20 years and it's at a reasonable valuation, it's most likely a good investment today. So I look at this as being de-risked. That's not to say it can't keep going down further. We probably haven't found the bottom because we've got all this downward momentum. If not, a bottom could take months, maybe years to form, get a good base and consolidation that we can break out of. So this is still a very speculative area of the market. Any positions should be small to moderate in one's portfolio, willing to accept a high level of volatility and uncertainty going forward. And there's plenty of choices out there, like FAN for wind energy, TAN for solar, LIT for lithium and battery technology. There's even one, Aqua, for clean water, CARS for EVs and mobility. If you believe in China and their pursuit of clean energy dominance, there's an ETF for that, KGRN. One I find interesting, a really small fund at 50 million, is Global X's fund, Clean Tech, CTech. With a reasonable expense ratio of 0.5%, geographically diversified, almost half in North America, and there's a look at some of its top 10 holdings. Bit of a broad array across different types of renewables, and there's a lot to choose from depending on what exposure you want. Here's the First Trust Clean Edge Green Energy Fund. It's totally exposed to North American stocks. Same with the Invesco Clean Energy one. That's all in North America, but if you want a bit more geographical diversification, you can look at things like Global X Renewable Energy Producers, ETF, RNRG, that's spread out across the globe. And my favorite, if you're looking for broad-based exposure, really diversified, big liquid fund, is the iShares from BlackRock, the world's largest asset manager. And their answer to this sector, the Global Clean Energy ETF under ICLN, $2.5 billion assets under management, 1.1% dividend yield, good expense ratio, 0.41%, and they're exposed to companies in all segments of renewable energy, biofuels, ethanol, geothermal, hydroelectric, solar, wind. 42% of the funds in North America, bit over quarter in Asia, almost quarter in Europe, and even Latin America, and a few other places they've got exposure to. And there's a look at their top 10 holdings, with 45% of the fund being in the top 10, and the fund having 103 total stocks in it. And just looking at AUM over the last year, this time a year ago it had 5.3 billion, now it's got 2.5 billion. So a lot of people have bailed on this, like we always see when industries and stocks take a dive. People just can't stand to see it going down and down all the time. They bail out on it. However, to me, that's the kind of setup I like to see. I want to buy off panicked sellers. As they say, one man's rubbish is another man's gold. And so there we have it, guys. A little bit of coverage of clean energy. Hope I didn't offend too many people with the material I presented. Once again, it's all just my own opinion. Not saying I'm an absolute expert on this topic. Just like to think I know enough to be able to profit from it. And I just think it's inevitable of the world's shift to clean energy, and I just want to be a part of that. So I hope you found that interesting. And because we've gone way into overtime here, I'm just going to quickly give you guys the bird's eye view of all the most important markets on the weekly charts, just so we can kind of see the main trends going on here. And there's a look at the S&P 500, just putting in its 13th green weekly candle in the last 14 weeks. The biggest parabolic rip we've had in the market in years, actually. And that's thanks to the rip and the Magnificent Six. After they've been consolidating for a few months there, what a runaway they've been on straight out of the gate of 2024. Same with Dow Jones Industrials, even the old economy blue chip stocks hitting all-time highs. However, still a bit of work to do in the small cap Russell 2000, which are mostly domestic stocks in the US. Nowhere near their all-time highs from late 21, seem to be stuck in this range they've been in for about a year and a half now. And there's a look at long-term breadth. Amount of stocks above the 200-day average, currently at 70%. You can see that started peeling away a lot earlier than the market back in mid-21 and kind of really bounced back in late 22. It's kind of held ground there, mostly above 50%. And with that, we've had the volatility come down in that time. However, we are getting a little bit of divergence with stocks hitting new highs. We're not getting volatility hitting new lows. May have found a bit of a floor here around 12. It looks to be consolidating there, but that's not going to last long, especially as we get closer and closer to the election. Markets pricing in a big spike come October in volatility. There's the bird's eye view on the 10-year yield. It too been consolidating for about a year now, trying to hold ground above 4%. And so a lot of people think the bond market did bottom back there in late October. Just looking at TLT here, there was a lot of volume around that time. Still a lot of volume coming in now. And if the Fed does cut rates this year, that should be supportive of bond prices, which would likely keep the dollar at least in a consolidation sideways range. There's a look at Bitcoin, which released those new ETFs to the market back up here. Seems to be consolidating, still holding above 40,000. And gold continuing to push up near those all-time highs made back up here. And again, another market consolidating. Crude oil, no seemingly clear direction or trend just yet. And just to show you the leading sectors in the market, there's semiconductors, home builders, industrials breaking out to all-time highs, and aerospace and defense stocks. Not too far off their all-time highs back here as well. Healthcare is pretty close, but the other defensive sectors like consumer staples and utilities still pretty relatively weak to the growth sectors. And one of my favorite sectors this year, cannabis. Breaking out to new yearly highs, looking really good technically. A lot of volume coming in here. We may just get the announcement from the DEA, they're rescheduling it from Schedule 1 to Schedule 3. Could be a sell the news event, but maybe not, because that could pave the way for Joe Biden to go full federal legalization, make good on his campaign promise, try and win over some young votes, and do something good at the end of his career and make good on that 1994 crime bill he authored, which unfortunately resulted in millions of young disadvantaged Americans being thrown in jail for small crimes. So hopefully we keep hearing good news coming out of this sector. We've already covered mega cap tech, good rip from Amazon this week. Nvidia seems unstoppable, and just look at that green candle from Meta. What an absolute rip. Not so much love for Tesla though. And there's a look at the world's biggest bank, JP Morgan now hitting $500 billion in market cap and hitting all-time highs this week as well. But one sector we'll be paying attention to is that of regional banks, finishing the week down over 7%. We've got some new troubles coming out of New York Community Bancorp. Apparently a few others as well. They are still not in the clear with commercial real estate. It's another risk factor this year. But there we are, guys. Can't argue with the technicals. We are in a bull market, have to be hitting all-time highs, and looks like we'll be hitting 5,000 for the first time ever next week. That's all I got for you for this week. I hope you enjoyed the show and found some value in it. If you did, please click that like button, and I'm interested to hear all your opinions, especially of clean energy. I welcome any criticisms as I reply to every comment, so I'm interested to hear what you guys think about all that and the market, the Fed, and kind of where we are with everything right now. So enjoy your weekend, and I'll see all you guys next week. Cheers.